Are you fearful of the ATO coming after you this tax time? Are you fearful of an audit? Well, today's video is for you because I'm going to go through the 4 key areas that the ATO are focusing on this tax time and what you could potentially do to minimize your risk of getting an audit or giving you that peace of mind that if you do get an audit, you're going to get that big green tick. Hello everyone, my name is Rooshock and today's going to be all about individual tax returns for 2022. We're almost in tax time. It means my life as an accountant is ramping up. I'm getting all prepped to get tax returns done. So I will give a quick plug at the start of the video. If you're interested in getting your tax return done, you can send me a message, get in contact with my business, Rooshock Accounting, or even better, you can get a part of the NFT project Rooshocks, where you can get 3 years of individual tax returns done, and they're 0.08 ETH, which is only about $120 Australian at the moment. So you're potentially only paying $40 for an Australian tax return done personally by me this year. So after that plug is out of the way, let's get into talking about the 4 key areas that the ATO are focusing on this tax time. So each year the ATO picks a few key areas that's going to be their main focus. It doesn't mean you can't get picked up in other areas and stuff. It's just things that they're putting out more information about. So therefore they expect people to get these things spot on. The more information they put about a topic, the more they expect you to understand it, have researched it, and make sure you're recording that correctly in your return. And that doesn't matter if you're doing it yourself or if you're using an agent, you still need to get the return right. You're the one that signs off at the end of the day. So the onus ends up being back on you, the taxpayer, to have your own tax return correct. The first one I'm going to jump into, because I know it'll get a lot of headlines on my own channel, is crypto. They're making crypto a focus again for 2022. They did it last year. If you lodged your own return, you might have noticed a pop-up saying, we know you've transacted in cryptocurrencies. Have you included these in your return? You're going to get that same pop-up this year. Your tax agent, if you go through them, they'll get that pop-up. And it's just a focus area for them. Capital gains in general. They want to make sure that anyone that has dealt with items that could carry a capital gain, such as crypto, such as shares, such as property, is included in the tax return. They're going to be focusing on this, and they will be pulling data from exchanges, whether it's your crypto broker, whether it's your shares broker. They get property data. They're going to have details to show that you have sold stuff. So therefore the onus is on you to include that correctly in your return. So when I approach these, I'll talk about each thing from 2 points of view. First, how can you reduce your risk of getting an audit? Well, the easiest way to reduce your risk of an audit in this area is to include all of these things in your return. If you've included capital gains, they're going to go, yep, that client had crypto and yet we've seen capital gains or capital losses in that return. That's going to straight away massively reduce your risk. Whereas if you get that warning and you include nothing, that's going to massively increase your risk because it's going to be an automatic trigger point. They go, we know they've got crypto, they've included nothing. That's going to be, it's going to put up red flags in their departments. So that's the easiest way to avoid or reduce the risk of an audit in this area, is to include something. And then the second area would be, okay, if you do get an audit, what's your best way to pass? And that's obviously always to include these things correctly. So go and use a software like, I'll put the link up to Crypto Tax Calculator, the review I've done on that, or I've got the Coiny link in the description. These softwares can help you with these things. If you've got shares, look at something like ShareSite, where you can import your data and then produce the reports, and you can verify that against pre-filler reports, or you can make sure you got your capital gains reports in there correctly. If you've got property, make sure you include the things that are relevant. Make sure you've gone and got the settlement statement from your purchase, settlement statement from sale. Do all these things right, and then you'll have no issues if you do get an audit in this area. The next area, and it's always a big one that they always focus on, is work-related expenses. So they want to make sure that what you're including at work-related expenses are actually work-related expenses. You haven't included things that are private in nature or that are not allowed to be claimed. So one of the key areas they're focusing on with work-related expenses this year is knowing that a lot of people have, say, moved to a hybrid or a work-from-home model. They're going to be focusing on, well, if your home office expenses have increased, you're claiming more for home office expenses, has your travel decreased? If you're not traveling for work or you're not using your car as much, they're going to expect that stuff to decrease, maybe even uniform and laundry costs. If you're not working, not wearing a uniform, well, they're not going to expect, you can't just go, I wore it for the whole year, or, I did 50Ks to travel a week if half the year you're in lockdown working from home. So making sure that you have adjusted for that is really key. So what can you do to avoid an audit in this area? Well, one of the key areas is they compare benchmarks based on your occupation. So if your occupation is a retail assistant, they're going to know that you're likely going to have very minimal work-related deductions for the average retail assistant. Typically a uniform might be included, or it might be really small. You're not going to be likely using your phone much or anything like that. So making sure you put the right occupation code is really key to making sure that your work-related deductions are getting compared against similar occupations. So you don't want to go and put yourself down as a retail manager if you're only working as a retail assistant, because obviously you're going to be compared to other retail managers, for instance, and the same goes the other way. Now, if you do get an audit in this area, what's the best way to make sure that you're going to get that green tick is you really want to make sure that you have only claimed things that are legitimate. Make sure you really do your research in this area, because the ATO are very strict when they do audits on work-related expenses, because they know that across the whole, it's one of the biggest areas where they're losing out, where people are overclaiming. So when they do audits, they really go down to every dollar. They'll ring your employer. They'll, make sure that the car that you've claimed is in your name, those kind of things. So really understand what you're allowed to claim when you're claiming work-related deductions. The next one is record keeping, which leads quite well in from work-related deductions. They're going to want to see your records of what you've claimed or what you've included in your tax return. So obviously get this up to date before 30th of June. So you're not stressing running around in July and then going, oh, I know I've expended on that and I don't have the receipt and I'm still going to claim it. That's where you can fall undone. Make sure you've got your records, because it's always a focus for them. You can have all the right data, include the right things, but if you don't have the right records to back it up, you're going to fall apart in an audit anyway. Now, this is kind of more of a posting. It's not really things you can do to avoid an audit in this area, but this all comes down to how can you pass an audit, and it's making sure you've got those right records, and also making sure you've got copies of them. If you've got a receipt that you think is going to fade, take a photocopy, take a photo of it on your phone at least, like store it digitally, so that, and then if you get an audit and they go, oh, you've said you've bought a new MacBook from JB Hi-Fi, you can go, yeah, here's my digital receipt. So if you go to something like JB Hi-Fi and they offer you a digital receipt, take it, get it. So you've got that digital copy and you don't have to worry about losing a receipt or the record fading. And if you do store digital copies, where are you saving them? Are you using the ATO app? Have you got a cloud service? Something like that, so that you don't lose a hard drive and lose all of those record keeping. And the final key area that they're focusing on this year is rental income and deductions. So my biggest point in this area is, one, make sure you're including your rental property. If you're renting out your property and you're getting income from it, it needs to be included in your tax return. You'll be surprised how often I get asked that question. But yes, it does need to be included. And then the focus comes on to making sure you're including the right income and the right deductions in that return. So you've got to keep good records and all those things, and understand there have been some key changes in rental properties over the last 5 to 10 years. They cut out, you aren't allowed to claim for travel anymore. They've changed rules around depreciation depending on when you acquired the property. So understanding these things to make sure you're not just rolling over what you did the previous year, because potentially if you've been doing it wrong for 3 or 4 years, if a change happened 4 years ago but you never realized and you've just kept doing it wrong, this could compound. And if the ATO come across you've done one return wrong, they could potentially look at previous years. So you need to understand that. So if you are unsure, seek advice. Go and seek advice from a registered tax agent. Seek advice from the ATO about what is actually able to be claimed for rental properties. A key area in this to reduce your risk of an audit is to make sure you're including the property, put the right property address, etc. The ATO have got good data matching. They're going to likely know whether they're pulling data to know that you own that property and it's being rented. If it's being included in your return, that straight away reduces your chance of getting an audit. The biggest areas that they're going to audit is when they know something needs to be included and you haven't included it. That's going to cause an automatic red flag in their system. And then reducing your risk of failing an audit, making sure you've included the right things, going through what I talked about before. Make sure you understand what's actually able to be claimed for a rental property and making sure that's what you've claimed. Because you don't want to go and claim travel and then they do the audit and that's going to be the first thing they see. Straight away, that's going to make them look way more in depth than everything else. You've already failed the audit. You're already going to have an adjustment. It's just increasing your risk of having further errors. So making sure you get those obvious things right is definitely going to help you if you do get an audit done. I hope that video has been helpful. Good luck for tax time for those who are doing their own return. For those that are going to agent, make sure you're asking questions to make sure your agent actually understands up-to-date tax rules. That's key. If they're aware of these things, that's already going to put you on the good path to making sure your return is lodged correctly. I appreciate you watching the video and I can't wait to talk to you again soon. Thank you.